CEO of Chevron, Mike Wirth. Mike, great to have you here on the program.
Good to be here.
Of course, I have to start with the news of the day here. Whatever ceasefire that we did have in the Middle East, at least for right now, seems to have broken down. A lot of questions right now about just how prolonged this closure of the Strait of Hormuz will be and just how much it's going to affect the economy.
I think it's still difficult to say, Romaine. It sounded as if there were plans to try to establish a transit corridor. Now we've got these reports that there have been some kinetic activity in the region. I've been in touch with our people that manage our shipping assets in the region, and we remain concerned about the security of transit. So, it seems like we still have, some issues to work through.
You are no stranger to Washington. You've had a seat at the president's table, more or less, multiple times here. What would your advice be to the administration to try to bring this to some sort of conclusion?
Well, my advice to the president really relates to energy markets, not to diplomacy and negotiations. And, I've advised people in the administration that this the buffers in the system that help ensure supplies are available to markets are being drawn down. And what that does is it creates more upside price pressure, potentially more volatility and more risk. And so I confine my discussions really to the energy system, not to diplomacy or the military side of things.
Fair enough. It is interesting, though. You think about where the U.S. sits in this. You look at net exports coming from the U.S. They've certainly increased. We saw that last week as well. But how long can that sort of continue and plug the gaps that we're starting to see in the global supply chain when it comes to energy markets?
Well, the U.S. is the largest producer in the world, and we've been exporting products, crude oil, gas, in growing quantities in recent years. And so it's a good thing for the world that the U.S. is able to help meet the need. That said, 20% of the world's energy supply flows through the Strait of Hormuz. That's oil, that's liquefied natural gas, it's refined products, goes to Europe and Asia primarily, and both of those regions are seeing the impact of having that much cut off. The U.S. can't make up all of that supply. Inventories in the system are being drawn down, and the supply situation is tightening, and that's a concern.
And, you think about the U.S. and where we stand when it comes to production. That, of course, has insulated the U.S. consumer to some degree from some of the higher prices that we're seeing in Asia, that we're seeing in Europe. And I just wonder from where you're sitting, how long you think that will continue to be the case? Or, is the U.S. heading towards a situation where consumers are going to see the same sort of prices that we're starting to see in Asia?
Yeah, I think the real thing is the U.S. is not going to see supply outages. We're starting to see risks of supply outages in some of these economies. In Europe, you're seeing flights canceled and schedules reoptimized because jet fuel is getting very, very tight in Europe. We've seen a number of economies in Asia that have instituted policies to reduce demand because they're concerned about running out of supply. Countries like Australia that have shut down most of their refining capacity and are heavily dependent upon imports are taking measures to address that. So I think the U.S. is going to see the price pressures. It's a global market. These prices are set in global commodity markets, but the risk of supply outages in other parts of the world is much higher than it is here in the U.S.
I'm curious. I mean, Chevron has made some big investments in the Middle East in recent times here. Has the situation over the last couple of months disrupted any of that, changed your plans at all?
We've got some production in Kuwait and Saudi Arabia that has been slowed down as we don't have the ability to evacuate it out of the region, and storage is filling. So we've seen some reductions in rates of production. We produce natural gas offshore in the Mediterranean that supplies Israel, Jordan, and Egypt. Our facilities there are running at full capacity. We've got some petrochemical joint ventures in the region that are cut back in terms of their production. So we're feeling this. We're less exposed to the Middle East than some of our peers, and so on a relative basis, the impact on our company has been lower than it has been for some others.
It still cost you about $3 billion in the most recent quarter, a lot of the volatility that we've seen in this market. I am curious as to how you forecast going forward without necessarily being able to necessarily forecast, military diplomatic solution to all this.
Well, forecasting in a commodity business is always a challenge because we have to assume what commodity markets will do, and they surprise us. What we're doing now is really working with scenarios. us. And so we look at different scenarios for when things might resume to a more normal state, what that means for supply in the world, what it also means for demand, as you see demand adjustments. And so we can't predict what the price will be and what supply and demand will be. We're looking at a range of alternatives and trying to use those to inform decision making.
And Mike, we only have about 30 seconds left with you, but do you have any plans to increase production in places such as the Permian, such as Argentina, as we talk about these supply shortfalls?
Yeah, we're up quarter on quarter, same quarter last year, 500,000 barrels a day. So we are growing. Our plans are to grow 7 to 10% globally this year. Demand is growing about 2%. So we're investing to grow at a rate greater than global demand is, and those supplies are sorely needed in the market.